Hey guys, and welcome back to another video here on the channel. If you're new, my name is Brandon. As always, we do have our Investing Academy, which is that first link down below if you're a beginner to the stock market. But in today's video, we have another episode of our 2 Stocks to Buy series. And this is a series where we cover a Canadian stock as well as a US stock, just to get a little bit of diversity. And these are 2 stocks that I've identified as potentially a pretty good purchase right now. And I say that despite the broader market reaching all-time highs. We've seen a lot of companies actually really rallying, and I've been rather cautious with my purchases and the stocks I've been looking at. But today I've got 2 really cool dividend stocks to talk about. If you enjoyed today's video, give this one a thumbs up. But we will start with our American selection for today, and that is the company Cisco Systems. The ticker for this one is CSCO. And if you were following along with the news last week, you'll know that Cisco shares dropped about 11% on the back of their poor earnings report. It was actually the single worst drop that Cisco has seen in about 10 years of trading. It was just a generally rather weak earnings report, along with the announcement that their current CFO is set to step down. So one of the things that they were really trying to blame this weakness on, as with what a lot of companies are doing, is the coronavirus and the COVID-19 really impacting their operations, which to me it's a valid point, but at the same time, potentially just an excuse for the weakness, because Cisco does have areas of their business like in-person installations, which would be impacted, but they still have a variety of ways of making money that don't involve the face-to-face meetings. One of the things that you could argue benefits from a time like coronavirus is their WebEx platform, which is kind of a comparable to Zoom. But in particular, I think why the shares dropped, if we do kind of take a highlight at the actual earnings report, investors were not happy about the weak guidance going forward. So Cisco as a company is projecting that over the next quarter, they're going to see their revenue numbers down about 9 to 11% on a year-over-year basis. And that's something that I did want to touch on in this segment with Cisco, is that if this is a company you want to look into more, if it's a company that piques your interest, you have to understand that the Cisco today is not the same company as it was over the past number of years. And Cisco, of course, is this massive technology conglomerate involved in networks, telecommunications, routers, switches. They do a whole variety of things, but they're not the hyper growth play that they once were. When you date back to the 1990s and the early 2000s, when Cisco was really one of the top technology companies out there, they've really evolved and transformed into more of this stable, more mature play. So to see revenue guidance at least down 9 to 11%, that's obviously not optimal. But we also shouldn't be expecting a company like this to be posting Amazon growth numbers or Tencent or Tesla growth numbers, because it's a very different company in a very different phase of its life. And that's why I mentioned this is actually a really good dividend play. If you do look past the weak quarter and the weak guidance going forward, the metrics, in my opinion, for Cisco as a long-term hold are actually looking decently attractive. For example, in comparing to its competitors or its peers in the space, we are seeing a forward PE of 14, which is below the sector average. Dividends as well are actually noticeably higher. We have a 3.32% dividend on Cisco today versus the sector average, which is well below 2. Let's remind ourselves that Cisco is a very good company based on the way their contracts work, the way their business operates at pulling in cash flow, which allows them to pay out really good dividends. Although revenues are dropping, we'd expect that to stay consistent. And the balance sheet on Cisco is actually a very strong one as well. So they have a nice cash pile they're sitting on, which can help them act as a buffer if things do continue to persist. But overall, the reason I included Cisco in today's video is I do believe that, more or less a philosophical way of viewing things, if you believe in a company like this for the long term, the drops in a quarter by quarter reports, 11% drop, a drop on weaker guidance, those do represent potential buying points. At a minimum, something to kind of nibble away at. And if things do persist, we can add more as the stock drops deeper. But Cisco is a company that has really got their infrastructure laid. They are going to be playing a big part in 5G, which is obviously a very high point of interest for a lot of the YouTube community. And it's just got a history of over the years being able to get through certain things with mergers and acquisitions. They've been through it. I'd expect the company to continue prospering, to continue adapting to the changing environment going forward. Of course, as I mentioned at the top, with a different style of management. They're not so much a growth company, but more of a stable play. To me, a drop like this does represent a time that we can start to look more at adding a position. Again, looking at a pretty attractive PE, especially for a technology company, and a nice dividend. So the stock currently trades for $42 USD. I actually do own shares in Cisco, and I did add some more on the announce of this drop, and I'll continue to monitor it going forward to see if I would like to continue adding as time goes on. Moving along into our second company for today, we're bouncing over to the Canadian market, and we actually covered this company in the passive income video that we talked about, the top stocks for passive income in Canada. This is the company Canadian Utilities. The ticker is CU.TO. And this to me would be a very suitable company for someone that wants the reliable dividends. This would pique someone's interest if they're a Canadian dividend investor. You're not going to be getting a whole lot of growth out of this company. As what they do, as the name implies, they're a utility company. They're based out of Calgary, Alberta, but they do have business that expands to up north, kind of unique area of business. Mexico, they even have operations in Australia. And this ranges from gas, electricity services, pipelines, generators, you name it. Just kind of that boring stuff that goes along in the background that people need. They don't really put much thought into it, but it's an essential service is really what it is. And this company is, when you talk about a reliable one, it's hard to find a more reliable stock out there. If you take a look at their earnings, about 95% of the company's adjusted earnings are regulated utilities. This is how the company can operate with extreme reliability. You'll notice their investment grade ratings. So this is by DBRS, so Morningstar and S&P Global. We see an A stable rating. We also see an A- stable rating, which are some of the top investment grade ratings a company can have. And then in terms of the dividend, we're looking today at a 5.30% dividend. And to me, as a bit of a rule of thumb when it comes to dividend investing, as the yields start creeping higher and higher, I start to get a little more skeptical. I usually like to aim for that 2 to 4% range. And when you see a 5% dividend, it does make you a little bit cautious, but not with a company like Canadian Utilities. And if you didn't catch that last video, fun fact about Canadian Utilities is that this is the longest track record of all Canadian publicly traded companies of paying out and increasing dividends. So a 48-year track record of increasing the annual dividends. So just think about that for a second. 48 years of not only paying them, but increasing them. And if you take a look at this table here titled Canadian Dividend All-Star List, which is basically a list of some of the top paying dividend stocks in Canada, at the very top of this list, you see two of my favorites. You see Canadian Utilities and Fortis, two powerhouse utility companies that are pretty much in a league of their own. When you look at this streak, 48 years, 46 years compared to the rest of the Canadian market, which still a lot of impressive dividends, but nothing like Canadian Utilities. It really is in a league of its own. And because of that chart that we looked at, with 95% of their earnings being regulated, this is a company that tends to perform well pretty much in all economic environments, which is actually why I think it's a good one to look into now with all the uncertainty about what's going to happen with coronavirus or a second wave or with a recession coming. There's so much to kind of think about and factor in, so many unknowns. This company has proven through, take a look at all the different periods, whether it be through the financial crisis, whether it be through the commodity shock. There's so many times, at least in this chart dating back to 1980, where you can make the argument that is not a good environment for stocks, yet Canadian Utilities is able to continuously grow their wealth pretty much year after year after year. And it's kind of why we included in today's video. Again, as I mentioned last time, not a flashy stock, but one that works, is one that you can rely on for your dividend income. And as the stock has dropped, it's actually down about 22% off these highs quietly. As a dividend investor, especially if I was a little bit older and watching this video, I would just be licking my chops here. to get a nice starting yield of 5.3%. Again, an amazing history on this company. You will note, as I touched on, you're not seeing the most growth out of this company. It's not a high-flying growth stock by any means, but if you're looking for a dividend stock, this is as good as it gets when it comes to the Canadian market. The stock currently trades for $33 Canadian. As I mentioned, it's got the 5.3 dividend, but Canadian Utilities is the Canadian stock to buy right now. So guys, those are my two selections for the quick video. Again, I'm not loving the market right now in terms of stocks to buy. And as I did my research, I was very selective in the options that I chose. What do you think about the two that I picked today? Do you like them? Do you dislike them? Do you own them? You can leave a comment down below and let me know. Or if there's any other stocks that you guys are really liking at the moment, feel free to leave them down below. As always, if you did enjoy this video and you learned something new, you found it helpful, you can feel free to drop a quick thumbs up. That is just a massive way of supporting the channel. It really does help out. And then of course you can subscribe for more content. We post videos like this every week. Well, we post this video pretty sporadically, like whenever I'm feeling like 2 stocks to buy. That said, we do post at least 1 video a week, sometimes 2. And then we do also have our Investing Academy. So if you're here in Canada and you do want some help with getting started and understanding the stock market and getting your account set up, we have a training program that takes you through the entire process. So click by click, all video lessons. We'll teach you the terms. We have a community that you get to join and ask questions in. That's that first link down below. But as always, I thank you guys for watching. I hope you enjoyed the quick one, and I'll see you in the next.